Markets always come back, Josh. No worries, they always come back. So yesterday the Dow, I guess the Dow was down 1,000 points. S&P 500 was down. Let's take a gander. Let's see what we got here. S&P 500 was down 155 points at 3.63%. Nasdaq was down 4%. All right, so S&P 500 is down over 3.5% in one day. Nasdaq down 4% in one day. Let's see the Nasdaq year to date. Went from high of this year, 15. Let's see, the high was on January 1st of Nasdaq. Come on, let me pause this. 15,832. All right, so we take our trusty calculator, 15,832 minus where it's at now, 12,334, divide by 15,832. Nasdaq's in full bear market territory. I don't think the S&P is that bad yet. Let's take a gander. S&P is at 41, started the year at 47.96, and now it's at 41.31. So 47.96 minus 41.31, divide by 47.96. S&P's down 14%, which is just a typical down year for the S&P 500. All right, but people say as always do, well, the markets always come back. Look at history. I said, okay, let's look at history. Oh, markets haven't come back here. This is Japan, by the way. I mean, look at that. Where's the Nikkei now? I'm not even sure. Where's the, let's give us the Nikkei. What is that? Is that the Nikkei February? Let's see where the Nikkei is now, shall we? Hold on a second. The close yesterday, the Nikkei is at 26,770. All right, the highest was what? Let's just do here. I can do here. Oh, the highest it ever was at, it does say, it just says 52-week high. All right, so the high was at what, 30? It was at 37 something back then. Yeah, right. 37, a little bit higher than that. Well, it's 38,000. Now that doesn't account for dividends, but the Nikkei is down here at 26,000, down from 38,000 in 1990. That's 1990 to 2000, 10 years. 2000, 2010, 20 years. 2010 to 2020, 32 years hasn't got back to where it was. Now, if you log it, it won't look as bad. Still hasn't got back to where it was. 37,724. Now it's at 26,000. Again, that does not include dividends, just FYI. But for those who say the markets always come back, no, they don't. If you're pulling money out of this, it never came back. That's the thing. If you're pulling money from this stuff, you're doomed. You're doomed. All right. Now, one thing I want to share with you: Nasdaq from 1980 was at 73 to 2000, March of 2000. Look at that. Woo, nutty. And then it went crushed, went up, got crushed again, and now it's up here again. All right, so if we log it again, we'll log it. I can't read these. Look at that. And it looks pretty brutal, doesn't it? And then, of course, it looks like it's way up from where it was. Let's not log it. Oh, let's log it, excuse me. So NASDAQ hit 7,677 in March of 2000. And now, as of quarter this guy, March of 2022, 14,220. What's it at right now? The NASDAQ is not at 14,220. It's at 12,334. 12,344. What did I say? 330. All right. If you're pulling money out of that, if we don't log, just to give you a sense of the decline, it doesn't. I mean, it's the same numbers. It just one looks worse than the other. Point being, if you've been pulling money out of this right here, you're screwed, man. Now, I just want to show you the Japan bonds. Here's the Japan bond rates going back to 1983, 84. We're going to start right here in 1990 when the markets started falling off a cliff in Japan, right there. You're getting 7.25 on the 10-year government bond. So you fast forward, you get 7.25, 7.25, 7.25. You come back to 2000. Now you're getting 5 and basically 5 3/8. Fast forward to 2010. Now you're getting no, I should be where should I be looking at? No, should be up here. Hold on a second. I get 5 3/8. So you're getting right down here. What is that right there then? Oh, it's because where I'm shining. All right, I got you. So right now, so you right here in 1990, you're getting 7.5 roughly, 7.25, 7.5. Fast forward to 10 years, you're getting about 2, maybe a little bit less, about 1.8. Fast forward another 10 years, you're getting 1.3. Fast forward another 10 years, you're getting 5 basis points. But the problem is, of course, though, is that these are giving you a positive return. Now you got to pay tax on that. If we look at net of inflation, you're still getting a positive return. Here's inflation in the green. Here's the bond rates in the blue. Other than this right here and right there, you're still getting a positive return. Historically, not all the time. I mean, right here, you got from 2016 to 2019, inflation was higher than the bonds. But then you can see that came back around. You can see the vast majority of time, your bond rate beat inflation. Not all the time, I grant you. Point being is the markets don't always come back. If you're pulling money out of the markets and the markets are getting crushed, you're in a world of hurt, man. I'm just telling you right now, you're in a world of hurt. And as such, stop either pulling money out of the markets if the stocks are way down, or recognizing that the markets don't always have to come back just because they have. They don't. They could easily go south for a long, long time, longer to be solvent, if that makes sense. John Maynard Keynes says, the markets can stay insolvent or irrational longer than you can stay solvent. Yep, exactly. Keynes was actually a pretty astute investor, by the way, which is interesting because he's the Keynesian economist. The markets can stay irrational longer than you can stay solvent, if that makes sense. Bill Bernstein says, a noted investment manager, if you've won the game, stop playing. Could not agree more, man. I just, again, we don't know if this is the beginning. I mean, we're in a full-fledged bear market now. Does that mean it's time to jump ship? Well, I don't know. The 20% bear market, let's go back to NASDAQ. 20% bear market right here. I mean, look, you're still well above where you were in 2019. 2019 NASDAQ was at 9,000. 2016 was at 5,500. So you're a 20% bear. Does that mean it's like, I don't want to jump, it's already down 20%. I'm not saying jump out of it. I'm just saying, man, protect the downside, my friends. Protect the downside. That's what you got to do. All right, love to hear your thoughts. We'll see you